Hello everyone, and welcome to NeoSystems webinar, GovCon Accounting 101, Understanding Contract Types. My name is Brian Giblin, and I'm a Senior Director of Product Marketing here at NeoSystems. And in today's webinar, we'll be taking this is the second in our series of GovCon 101. We're doing this in partnership with SCORE, and I'll have a little bit more about them in just a moment. In our first webinar, we did direct versus indirect rates and understanding wrap rates. We did that back in January. As I mentioned, today we're doing contract types and pricing. And then we'll be moving on to understanding DCAA, as well as a webinar on cash management. You know, after all, if you win a contract or a large contract, all of a sudden the cash management challenges that come with that are worth understanding and being able to handle so you can successfully deliver. All these webinars are available. You can register for free, and you can register for them on our website, neosystemscorp.com. We also have a workshop coming up in conjunction with SCORE, which we will be doing on April 22nd at the SCORE offices in Washington, D.C., and that is a half-day workshop, and registration will soon be available for that on the SCORE website. So I thought it would be interesting to take a look at the contract marketplace. Many government contractors are interested in what's available out there. In fiscal year 14, there was $443 billion in contract awards. Now, this doesn't include things such as the intelligence budget, which are not available or publicly disclosed, and there are a few other exceptions as well. But $443 billion were awarded in fiscal year 14. Of that, the vast majority, almost two-thirds, was fixed price at $278 billion. And there's a small sliver, time and material contracts, of $18 billion. You know, I'm just realizing now to use a small slice, the word small slice and the words $18 billion in one sentence. You know, I'd even take a small slice of the $18 billion and be in good shape. Also, about a third of the contract awards last year were cost plus. So if you've been avoiding cost-plus opportunities with the government, then recognize that you're giving up and passing on 1/3 of the contract dollars. So getting into our agenda, we're going to have a brief introductions, and then we're going to get right into the meat of our presentation on contract types. We'll be going through each of the main contract types, and then have a discussion on best practices for pricing of contracts. And then we'll open it up to your questions. If at any time you have a question during the presentation, please feel free to type your question into the question box. First, a little bit about SCORE. SCORE is a nonprofit association, and it's dedicated to entrepreneur education. They're the premier source of free and confidential business advice to entrepreneurs and small businesses. They provide face-to-face business mentoring, as well as the low-cost workshops, which I mentioned earlier. The DC chapter of SCORE has over 50 successful executives who are available to provide the relevant business advice you need to help get your business off the ground and growing. And if you have more questions about how to connect with a mentor or to register, please visit their website at washingtondc.score.org. And a little bit about NeoSystems. At NeoSystems, we focus on the back office. This includes accounting, IT, and HR, or human capital. We focus on highly regulated industries, including government contractors, nonprofit organizations, and certain commercial industries. Now, I'm not going to go through this whole slide, but there's a lot of material here. But I just want to highlight a couple of things. You know, I mentioned accounting. We provide accounting. The back office accounting, we do the accounting for a large number of government contractors. We also provide the IT support. This could be hosting, or it could be help desk and application support. It could be running your email for you. We also provide HR management. Could be helping with recruiting, especially if you have some new opportunities you're looking for. How can you recruit that key talent that you need? Onboarding, payroll, all your HR services. We have 4 offices. Currently, I'm in our Tyson's office, as we also have a new office down in Orlando, Florida. Now, I mentioned hosting. Currently, we have over 575 clients in our hosting environment, and this represents over 45,000 employees, people doing their time and expense reports through our hosting environment. One last item I want to mention is we've been on the Inc. 5000 list for the past 5 years, but what we're more proud about is the over 30 clients we have that also joined us on the Inc. 5000 list this year. But that's enough about us. What I'd like to do now is get to know you, our audience, just a little bit better. I want to get a sense of what is your experience with government contracts. You know, some of you might be just starting out with government contracts. You know, you're looking at winning your first one. You're proposing your first government contract, haven't won one yet. Maybe you've won 1 or 2, even up to 5 government contracts. Maybe you have a little more experience, won 6 to 10, or maybe you've been doing this for a number of years and won 6 to 10 or 10 or more government contracts. So I'll let people put in their answer the poll. Give you a few more seconds here as we let people get their results in. I'll give you 5 more seconds. 4, 3, 2, 1. Close the poll. Let's share the results with you. Very good. And this is sort of in line with what we expected, that many of you would be new to government contracting. This is a GovCon 101. But then it moves right through, and some of you have experience with government contracts, and that will be a lot of information for everyone in this webinar today, from the very beginner to those companies that have more than 10 government contracts. I'm sure you're all going to take away quite a bit. Now I'm going to turn it over to Sean Chen. Sean is our Vice President of Client Services. He has over 18 years of experience in accounting and financial management roles with our clients, specifically in the government contracting industry. He's responsible for delivering strategic financial management advice to our clients, as well as overseeing the day-to-day accounting operations for them. So with that, I'm going to turn it over to Sean.
Thank you, Brian, for the introduction, and thank you, everyone, for joining our webinar today. We have a lot of material to cover, so we'll go ahead and dive right in. As mentioned in the previous slides, we're only going to cover these 3 contract types. They're pretty much the most common and most that everyone's really familiar with. And firm fixed price, cost plus award / fixed fee, and time and materials. So as you all saw on the pie chart, the different contract types, where 63% of the awards were fixed price, 33% were cost reimbursable type contracts, and 4% were T&M. So here in this picture here, it shows you from a contractor perspective, you all, how each contract has a high and low risk, okay? So for fixed price jobs, they are relatively high risk for you as a company. Reason why they're high risk is that once you submit your pricing within an RFP and that set dollar value is in the government's hands, it's up to you as a contractor to be able to meet those deliverables, perform the work within the scope of work, and be able to finish the job within that particular pricing range. So the reason why it's high for you is that sometimes there could be scope creep or different types of variables in there that were unforeseen, where you could expend a lot more labor, expend a lot more costs to get the job done, but yet you're only able to bill the government for whatever is negotiated, whether it's on a monthly or by milestone or deliverable. So in a lot of cases, you could lose a lot of money on fixed price jobs, but at the same time, you could maximize profit, and we'll get into that a little bit later here on the slide. Now, on the low end risk for the contractor are cost plus or cost reimbursable type jobs. And the reason why they're low risk is that you will always be able to recover your costs. So if you're bidding out at G&A at 10% and you end the year at 18% G&A, let's say, at some point during the contract life, you'll be able to invoice the government for that particular variance. So you'll always be able to recover your costs, and there will always be certain amount of profit that you're able to recover year upon year. Now, T&Ms, they're right in the middle. They can be beneficial for subcontractors, and they, at the same time, can be high risk, low risk. Same thing with the government. They can be beneficial and high risk, low risk. So T&Ms are right in the middle. So first contract type that we'll go through are the fixed price contracts, and the government issues an RFP for fixed price jobs when there's a definitive performance specifications within the RFP. They understand that there's a set price for work to be done on their end, and for more definition on the fixed price jobs, you can find that in the FAR 16.202-2. So some of the benefits for fixed price contracts is that, again, you can maximize profit potential, okay? So if you've been in the government contracting business for a while and you know that sometimes there are unforeseen costs or there is usually scope creep within the RFP, and depending on how you price that, you might be able to say, okay, well, I want to price out this job for $100,000, let's say, for simplicity purposes, but you're able to complete the work for really $80,000. Well, you know, you're making pretty much 20% profit on that. That's a really good deal for firm fixed price contracts. So that's a benefit for these type of contracts. When you're bidding out and when you have the majority of your contracts as firm fixed price, it gives you incentive as a company to really control the cost within your operations as well as your contract. And by controlling costs, you're going to improve your profits, and you're going to ensure that that the deliverables are met on time through this firm fixed price job. Obviously, if you're spending a lot of costs and a lot of resources in to get the job done, most likely you're having a difficult time meeting those deliverables and milestones also. And as a general rule of thumb, pricing for fixed price job contracts are less complex than other ones. So again, some of the contract risks are you as a company assume full cost responsibility. So what that means is that no matter how much labor and how much materials it takes to get the job done, you're only limited to what you propose to the government. So your labor and your materials, if they go to overflow, you're assuming the full cost responsibility of that. It's very, very difficult for you to recover those type of costs. And a lot of the contracts and RFPs that are coming out now are LPTA. So that even puts a further strain on you as a company. And it's high performance, and it really gives a lot of risk to the contractor from if you're going after LPTA type work. Some of the best practices for firm fixed price in the bidding and the cost volume, know the impacts of all the contract requirements and your specifications. Be sure that work can be completed for your proposed hours and costs. Again, these type of webinars are really high level and top view of contracting and government, the government contracting arena. So when you're bidding out your RFP, you know, throw in an extra few hours, throw in some type of unforeseen costs, so that if anything, you can be sure that even if you were to have overrun within a particular milestone or deliverable, that you have those kind of costs covered. And this is really key here, the last bullet, prevent any subcontractor overrun. So if you prime the contract and you need some subcontractors to perform a specific part of that particular contract, keep your subcontractors in line. Subcontractors are out there to make money also. And so sometimes they might give you an invoice where you're not really paying attention to the amount of hours or the amount of cost that they're spending. But when they give you that invoice for work that they've performed, guess what? That eats against your available funding for that particular contract. So keep a close eye on those subcontractors. Next one we'll get into are T&M, or time and material type contracts, suitable for the government when they cannot accurately estimate the extent of the work, the duration of the work, or they really can't anticipate the amount of the cost with a degree of confidence. And the definition of the time and materials can be found in FAR 16.601. So the contract risks and risks for bidding out time and material type work is that there can be wide salary variations within your labor categories, and salary may not cover costs. So what that means is that within the RFP there might be a labor category, for instance, like a project manager, and so you bid a project manager at a certain salary rate, okay, and once you loaded it with fringe, overhead, and G&A, you come up, and profit, you come up with a bill rate. But when you're actually going out and trying to recruit that particular project manager, they might ask for a higher salary than what you've proposed, okay? And in that case, depending on the variation, it could eat into your profit and ultimately erase your profit within that labor category. And unfortunately, you would be stuck with that particular bill rate because that's what you propose to the government. So other things that can affect profit and labor or billing rates are your internal rate changes, such as raises, promotions. When you're bidding out on time and material type RFPs, make sure you factor in rate escalations year upon year. And then the last risk is that since they're labor categories utilized to perform a specific function within the contract, it can be pretty difficult to staff once a resource leaves or a resource goes to another contract, because the government is looking for specific specifications and requirements for that particular labor category. So anytime you don't have anyone working or filling in for that particular labor category, it's lost revenue, lost profit, and lost cash for you as a company. So the time and materials best practices, propose higher than normal rates for your highly skilled resources, especially like key personnel. So let's use the PM for example again. If you go to salary.com and it says, PMs for this particular area or the area that the work is going to be performed is 150,000, propose 160,000. You can always negotiate on the profit, and understanding that the beauty of, let me tell you, that the beauty of a time and material type contract is this, okay? You propose $150,000 salary, you find someone that can do the job for $120,000. That's where the benefit of time and materials come into play. So always kind of propose higher than what a survey or a salary.com type website tells you. Ensure your forward pricing rates cover the average of future costs, including reasonable profit. What that means is that hopefully, since you all have kind of gone through some contracts or you're looking to go into contracts, what you want to do is that you want to forecast out what your company operations will look like with the addition of a new contract. So if you're going to add in 10 FTEs or 20 FTEs, make sure that you factor in those costs, those billable employees, because what that will do is lower your indirect rates, hopefully, and you're able to include a better profit, but at the same time, you're more competitive because your indirect rates are lower with those expected FTEs, okay? So we'll get into kind of forward pricing and provisional rates a little bit later in the slides, so it can be more clear. And if your hours are limited in the contract, limit the total hours combined and not by labor category. So you don't want to be stuck with, hey, I'm assuming that my PM within the contract will do the job for 100 hours, because what you can run into is that the PM might need extra time instead of the 100 hours. So if you propose to the government PM 100 hours and they need 160 hours to do that job, in some cases you may not be able to charge those hours to the government. So the fun one we'll get into is the cost plus fixed fee type contracts. One, they're very difficult to win. And the reason why they're very difficult to win nowadays is because a lot of them are LPTA, same thing with firm fixed price jobs as well. But there's a caveat to that cost reimbursable type work, which we'll get into in here shortly. So the government uses cost reimbursable type contracts when there are uncertainties involved in contract performance, and they really can't be estimated with any type of sufficient accuracy. And the allowable profit is really limited to anywhere between 2 to 8%. Now, 8% is really the high end, but when you're bidding on RFPs that are cost reimbursable type work, never go for the maximum because the other bidders behind you won't also. They'll use a 6.5 to 7 to 7.5. So if you're going to bid for the maximum type profit, more often than not, you're going to lose. So some of the contract benefits for the cost reimbursable, and really the main benefit of it, is that you're able to recoup all of your allowable direct and indirect costs associated with the contract. And it gives you some flexibility when estimating out costs. And I want to say that recoup all allowable direct and indirect costs with a caveat. So, you know, the government's not stupid. If you're bidding out 10% G&A and you end the year at 30% G&A, well, most likely you won't be able to recover that. Okay, and we'll get into that a little bit later. So some of the contract risks are government not obligated to reimburse contractor for costs in excess. That's exactly what I was talking about. If you're bidding 10% G&A and you're really lowballing the government just to win the work, and you know your company ends the year at 30% G&A, you're not going to be able to recover those costs. There are specific agencies in line to make sure that those type of scenarios don't happen, and those agencies are DCAA and DCMA. In your award or your pricing, if there are big changes within the company, if you have an unforeseen cost, or you want to invest a lot of money into your company infrastructure, you know, that's going to change your rate. That's going to change the way that you're billing the government. Notify your contracting officer of those type of changes. And once you're able to get a cost plus type work contract, you're subject to incurred cost emissions. And what that means is basically you're giving the government your financials so that they can do an audit to make sure that your costs and your billing are in line with your estimates. Some of the best practices for cost plus is watch your contract costs and funding very closely. Again, notify your contracting officer if you need more funding, so there is no risk funding, and explain to why you need the funding to the contracting officer. Monitor your contract and all contracts for scope creep. Work off your provisional rates and adjust each year. We'll get into provisional rates a little bit later. And no fee on top of fee. So if you're a prime and you have a subcontractor, make sure that because the subcontractor is going to give you their proposal to it, they're going to give you their pricing, and they're going to have fee on top of they're going to have fee on within their cost or pricing. Okay, and when you get that pricing, make sure you don't add fee on top of that. So that's what's called fee on top of fee. That's an added extra cost that the government won't pay for. And cost plus award fee contracts are very similar. I'm not going to really go into everything again. They're very similar to cost plus fixed fee. The only difference is that there is an award fee. So an award fee is basically a good job type of bonus that the government gives you as a company. So they can be earned in whole or part during your contract performance, and they have the same benefits and they follow the same guidelines as cost plus fixed fee jobs. Okay. So the award fee is usually awarded to you as a company if you meet a certain milestone within a given time frame, or your performing work is above the normal. They'll be able to give you an award fee, and that language is usually within the RFP. It's usually a certain percentage of the total cost, and they are determined by solely by the discretion of the contracting officer and the customer. It's not subject to appeal. So if you don't get a specific award fee, or if you are expecting a certain amount, they don't necessarily have to pay you. And again, these type of contracts are subject to DCA audits and incurred cost submissions. And again, going through some of the best practices, they follow the same guidelines as cost plus fixed fee. Maintain satisfactory performance throughout the contract. That way you could result in early award fee or a large chunk of the award fee. So we'll go ahead and get into pricing principles and why we price as a company. Obviously you want to improve your cash flow for profits. You want to price to win contracts so that your company can grow. You want to establish past performance, and you want a piece of the market share. So some of the credible characteristics of pricing have clear identification of the tasks at hand, understand what the RFP is saying, have broad participation in pricing preparation. So if you're a one-person shop or a few employee shop, try to get others from the outside that have experience in pricing and RFP preparation. Obviously have valid data and accessibility to that valid data. Standardize your structure for estimating. Recognize inflation. Recognition of excluded costs and burdens. Make sure that you're able to separate out your allowable versus your unallowable costs. And revision of pricing estimates for any type of program changes that you can see or understand within the RFP. So here are some primary and secondary sources for pricing. Obviously, the primary ones are your accounting records, your cost reports, historical databases, indirect cost reports for those that have accounting systems that can generate that, your contract briefs, having subject matter experts to be able to provide the data that you need to price, the recruiting, and the technical databases. As you can see, some of the secondary sources overlap with your primary, but some of the secondary sources would be cost proposals from previous RFPs that you've gone after, some focus groups, research papers. Competitor intel is always very important. Know who you're bidding against. If you can try to get their rep rate or their cost, especially with the incumbent that's already in place for a particular contract, if you can get that information, that'll help you and obviously give you an edge in pricing. So some major risks in contract pricing. Some of these risks and uncertainty arise from these sources. A lack of understanding in RFP requirements, different interpretation of the language. So if you have two people working on a cost volume, ensure that you all are on the same page and that you all understand what the RFP is asking you and what the cost volume is asking you. I've done this before, and I'm sure many of you all have. It's the 11th hour, and you're trying to get the pricing out, and you're working quickly just to get the pricing out. Haste is a really big component in having some pricing deficiencies. Poor cost estimating and pricing practices. If you don't have a really good provisional rate forecast or a spreadsheet that can give you that kind of cost estimating, that can hurt you in contract pricing as well. So here we're going to get into how you build up an hourly rate. So once you're able to have all of those sources together and you have your cost estimating and you're getting ready to build up your cost volume and your pricing matrix, for those that don't know or just need a refresher on how to build up an hourly rate, here it is. So we're going to take a raw labor of $48.08 an hour, and we're going to assume that you have fringe, your overhead, and your G&A. So fringe here is 32%. You multiply the 32% to the 48.08, you get 15.38. Same thing with the overhead, but this time you're adding in the hourly rate plus the fringe rate, then you're multiplying the overhead. So then with the G&A, you're taking all three, raw labor, fringe, and overhead, combining the sum, and then multiplying that by the 8% in this example here. It gives you a total cost of the employee at basically $85 an hour. So what that means is that instead of the employee costing you, the company, at $48 an hour, really the employee costs you $85 to keep the employee within your company, okay? So that's what's called recovering your cost. You're recovering your cost, you're breaking even at $85 an hour. Now you want to add in profit or fee, you're putting in 10% on top of that, so now your total bill rate that you want to invoice the government is $93.48. And the example and the formulas are on the right-hand side there. So once you're able to understand your fringe, overhead, and G&A or any other indirect rates you have, you're able to come up with what's called a wrap rate. And a wrap rate is quick math to understand exactly how much cost or how much dollars you need to be able to recover all of your costs, okay? And so that's what a wrap rate is. So the assumptions are fringe 32%, overhead 24%, and G&A 8%. That calculation is basically 1.32 times 1.24 times 1.08 gives you that wrap rate of 1.767. So nowadays, especially in the LPTA type world, 1.5 to 1.8 is a good range. Obviously, if you're at the lower end of the spectrum, you have a lot of good things going on within your company, and your chances are that you'll be able to kind of win that work, or at least be in the competitive range. So once you're able to figure out what your wrap rate is, and you have established your indirect rates and all that jazz, and you have valid, good accounting data, you're able to do a pricing build-up, which most RFPs have a particular matrix like this one in this example. So let's just go through the project manager. Salary is estimated at $150,000 a year. Breaking it down to 2080, you can sometimes break it down to 1920, however you want to do it. But in this case, it's broken out by 2080 hours for the year. That gives an hourly rate of 72.2. We're adding in fringe, we're adding in overhead and G&A and fee to give the government a fully loaded rate. So this can be done for fixed price type jobs, T&M type jobs, and cost plus cost reimbursable type jobs. And in this case, I'm listing out different labor categories within an RFP. So with that particular example there, if you're able to develop provisional rate pricing, that's even better for you as a company. So provisional rates are utilized for both pricing and billing. They can be reconciled and must be reconciled to actual rates at contract closeouts, and for cost plus reimbursable type work is audited by DCA. So what provisional rates are estimating out the amount of FTEs that you're going to be incurring for a particular contract. Once you're able to build in those FTEs coming aboard to your company, you're able to factor in other costs as well. You know, the fringe costs for those employees, computer expenses for those employees, rent space if you need rent space, and you factor all those other costs in, and at the same time you're going to be able to get an estimate on your revenue as well. Once you're able to gather all that data together, essentially you have a budget, okay? And you're able to use those budgeted rates for your work that you want to propose in an RFP or that you'll use for cost-plus work, okay? So cost-plus work is that you establish provisional rates. You can use that for billing for that following year, and then you basically reforecast or rebudget your expenses for the next year. And any change to your provisional rates or your estimates or your forecasts have to be supported by your accounting data regarding your actual financials and your actual rates. If they don't, and if they're not in line, that could start a whole series of questions by DCMA or DCAA. So here's the difference versus actuals and provisional rates. So actuals mean your true indirect rates at the end of a specific period of time. So let's just say at the end of 2014, you end the year at 30% fringe, 25% overhead, and 9% G&A. So your fully burdened or your wrap rate is 1.775. But let's say that you're going to go after a few opportunities within 2015. So now you're going to factor in those potential wins, and you'll come up with lower fringe rates, lower overhead rates, and lower G&A rates. So now your wrap rate is, in this example, 1.58, which makes you a lot more competitive than you using your actuals. So here is the same thing with the pricing matrix, but then it gives you the contract terms for base period, option year 1, option year 2, option year 3, and option year 4. And as you can see, each one of those particular years, the same labor rate or billing rate is increasing each year. So you always want to build in escalation factors when you're pricing out contracts. So the advantages of utilizing provisional rates and escalation factors are, one, for provisional rates, you're more competitive in pricing right off the bat. Gives you advanced capabilities in estimating and forecasting. As time goes on, your spreadsheet or your forecasting tool will begin to expand. And as it expands, you're going to be a little bit more advanced in calculating certain indirect rates. You may split out and figure out that splitting out your overhead pools makes more sense than having one overhead pool, for instance. The advantage of having provisional rates, again, is being able to compare actuals versus target, and you're able to control your costs, and you're able to monitor those costs. At the same time, it gets you in the foot, it gets your foot in the door with DCA as far as interaction. You can submit provisional rates to any DCA office within your region. They don't necessarily have to approve them, but hey, they'll acknowledge that they have provisional rates from you. And really, the last piece of it is best practices for your cost volume is follow directions. Everything is really spelled out in the cost volume for you to follow along, from the description of your indirect cost pools to the reasonableness of your cost pools and how you allocate them out. And a lot of times I see our clients prepare a pricing matrix and price volume, and they feel comfortable with the pricing and they feel comfortable with the total cost. But in reading the cost volume, they fail to follow some direction, so they have to redo the whole thing. So this one piece alone will make you lose a lot of different contracts. So I'll go ahead and that's it for our webinar. We'll go ahead and turn it over to Brian for the final slides, and then we'll be back to answer your questions.
Thank you, Sean. And now that you've gotten a lot of information from Sean, a lot to digest there, to be sure, I want to open up our next poll question is, what are the biggest challenges or concerns that you have when submitting proposals? How's it going out there? Are you losing on price? Are you having challenges recruiting and retaining quality employees? I know in these days of LPTA, that's a big challenge for people, is getting people that have the qualifications at the price. How's your accounting system? Is it able to provide the proper data you need for, whether it's pricing data you need or just the data you need to manage your contracts? Make sure you can deliver on time. And being able to meet contract compliance requirements, that's a big part of it as well. Check all that apply. And of course, maybe you have no challenges. It's a perfect world for you. You've got it all down, and you've been just joining us for this webinar to make sure you've got it all under control. Going to give a couple more seconds, 5 more seconds, 4, 3. Wow, look at, every time I start the countdown, a lot of people start voting. 2, 1, close the poll. Let's share the results. And, I'm not too surprised with these results. As I said, LPTA, a lot of people losing on price. It can be a very competitive world out there. And, one of the things we've seen is, looking at, how to make sure you're in compliance, not compliance, but how to make sure you're competitive with rates and things like that. We've done a lot of look at that as well. The recruiting, top key talent, very, very much top there, and across the board, a lot of common challenges. Do you have anything you want to add, Sean, to this?
Well, just overwhelmingly, it's losing on price, and that's not surprising at all for really small government contractors. And I know that you all might have a lot of questions and not really understand how to lower your costs and how to be more competitive. If you all want some kind of more dialogue between us, please feel free to email either Brian or myself at the end of this webinar. We can talk further.
Thanks, Sean. So let's close up the poll. And one thing I do want to highlight is a few resources that are available to you. Sean's mentioned several of these organizations, DCAA, the FAR. We didn't want to go through and list the whole FAR. That would be more than this whole webinar itself. But if you wanted to look up some of those clauses that he referenced, you could go read them directly here. And also NeoSystems provides some free resources like this webinar. We have our blog. We also have training classes. Those are paid classes, but we have training classes as well available. And anytime you have questions, feel free to either email us at goahead@neosystemscorp.com, or you can email Sean and me directly. Now what I'd like to do is open it up to your questions. And please, as I mentioned before, feel free to type your questions into the question box. I'm going to take the first one, Sean. Will the PowerPoint slides be available to the participants? Yes. As for joining us today, we feel free to share our slides with you. We ask that you don't publish them to the world, but one-on-one, we're happy to share them with you.
Okay, so first question is, on a firm fixed price, if we win with the price labor category at X and we find and we find someone who can do the work for a rate less than X, can we still invoice the government at the proposed awarded rate? Absolutely. I mean, that's what you want to do, right? That's how you're going to really make money, is that if you can, if you propose the government at a certain amount and you can either do the work for less amount of hours or less than the cost, that's absolutely what you can do. So yes, to answer your question. Next question on T&M. I'm a subcontractor bidding for a contract to a prime. As a new small business, I have no past financial statements, so I am projecting my indirect costs. Is prime allowed to audit my indirect costs to adjust my multiplier wrap rate? That's a good question. And I will tell you this, and that companies that are going after prime work that want subcontractors on their team, it's a cutthroat business, the services, and I'm assuming that it's all services that you're doing. So everyone wants to make profit, and everyone wants to make money in this environment. So you being a small company, unfortunately, you will get taken advantage of because, yes, they can tell you, well, I can't do the work. You know, your costs are too high. I need you to adjust it down to X amount of dollars. And unfortunately, you're trying to win work also. So what are you going to do? Of course, you're going to adjust your rates so that you can make, so that you can make money or that you can get that past performance. So they are allowed to look at your costs. They're allowed to look at the buildup of that because, quite honestly, they can go to another sub if they really want to, unfortunately. So, sometimes as a company, it really behooves you, especially if you're small, to keep your costs under control, to have good financial trusted advisors that can make critical decisions like that so that you don't lose money on the back end when you're trying to make these deals as a subcontractor on a job. So that's what I can say about that.
Sean, I want to kind of get a clarification when you say they're allowed. So would it be fair to say you're also allowed to say no, you can't look at them, and then the prime is allowed to go find another sub who will do the work for the price that they want?
Right.
So it's that sort of a competitive environment where, yeah, if they have to go with you, then you can say no, you're not allowed to look at those,
right.
depending on a T&M job.
Right.
But otherwise, yeah, but they have the right to say they're going to go elsewhere.
Yeah. So there are versions of sanitized and unsanitized costs. The sanitized is usually given to the prime, which just has basically labor category plus your bill rate, okay? And then more oftentimes than not, the unsanitized version just goes to the government agency so that they can see your cost buildup, how you came up with that particular rate. A lot of times, the prime will ask for your unsanitized version also. So it's how willing are you wanting to fight back with the prime. If you want to stand your ground and say, look, I don't want to show you my rates, I don't want to show you how to do a cost buildup, that's up to you as a company. Then there are other variables factored in, the relationship between you and the prime. Are you planning to do more work with them? All those factors have to be taken into consideration. But yes, they are allowed to.
Good. And one of the things, as we think back to the last survey where we saw a lot of people losing on price, one of the tips we recommend, and maybe you can speak to us a little bit more, is if you lost, did you go to the debrief? Did you ask for a debrief on how you did? And can you speak more to that, Sean? On a contract award, if you lost, you go and you get a review from the contracting officer. Where did we do well? Where did we
right.
not get as many points? And how did we stack up and get that information from the government?
Right. Yeah. Something was wrong with my earphone.
Headset problem.
Yeah.
Sorry.
But right. I mean, contract briefs will tell you a lot of where you hit and where you miss. Sometimes if you're priming for the work, yes, you'll always get the prime, but the contract brief. But sometimes primes won't disclose all that information to their subs as well. So always ask for the brief when the award is awarded. That way you get full disclosure as to what happened.
Yeah.
And the other problem is that when you're subbing, you're really at the mercy of the prime. So if the prime loses because of price, but you feel relatively comfortable with your price that you've submitted to the prime, you're always at the mercy of that bigger company,
right?
Because there's nothing that you can do. You've only submitted your cost to them, and in turn, they're including your cost within that proposal. So you're always at the mercy. So we try to ramp up clients from a subcontractor perspective to a prime candidate rather quickly. And by doing that, we really have to manage and restructure their rates, ensure that everything is in compliance and in line, so that they're ready to go after prime work. All right. So let's see. Is price settlement available before any work performing? Yes and no. That is something that is worked out with the contracting officer once the contract is awarded. However, as some of you all may know, there are BAFOs also that when you submit an RFP, if you're in the running and if you're on the short list, you'll usually receive a BAFO or best and final offer coming back from the contracting officer saying, hey, is this your final offer? Can you cut down on anything and stuff like that? Usually that's a really good sign for you as a company.
And Sean, one of the things I was going to touch on again is you mentioned how we help our clients get to being the prime contractor and subbing. I think it goes back to your one slide you had on why do we price, which is really pricing strategy. Are we pricing to get cash flow? Which then we might have certain terms in the contract. Are we pricing for profitability, or are we pricing for the past performance? So we can say, even as a sub, maybe as a sub, but we did work for agency X.
Right.
That past performance then gives you the credibility next time around to go in as a prime. So that's always good to have an overt conversation with your pricing team and the whole proposal team. What's our pricing strategy here? Why are we doing it?
And what's our goal? Exactly. So if you're in a growth mode or you just want the past performance, yeah, you might want to take a hit on profit just so that you can get your foot in the door within that particular service industry. If you're looking for profit, pricing, understanding why you're going after the RFP is the first step. Okay, so can we get access to part 1 of this series?
Yeah, and I think if you're interested in seeing the slides from part 1, please feel free. I would just put it in the comment box, the question box right now. Say, I would like a copy of part 1, and we'll be sure to get that out to you.
How does the insurance system cover both the contractor and subcontractor? Do you control the subcontractor's risks in advance?
Do you want to take that one offline, because I'm not sure I understand that question?
Yeah, I can take that offline. So the person that asked the question, if you can email both of us, we can help you answer that offline. So I think that does it. And we'll be sure to send out the presentation to all those that have requested it. And again, wanted to say thank you for joining the webinar, and we look forward to seeing you all in the next one.
Thank you, everyone. On behalf of NeoSystems and SCORE, thank you for joining us for our webinar today. If you're interested in the future webinars we have on DCAA, understanding DCAA, and as well as the one on cash management, please feel free to visit our website, neosystemscorp.com, and register now. Thank you, everyone. Have a great day.